Fashionably late.
We apologize for being 30 seconds late. Hello, everybody. I think we are.
Happy red zone to some people who are now in red. You can go back out. It's quite nice.
We are
back out. I'm sorry for all you Torontonians who are stuck inside still.
Still waiting on the freedom to be able to get back out.
On the freedom.
Look at all these people coming in. What's going on, everybody? What is going on? Hello. Today we are. If you haven't seen our video, they dropped on Friday. Oh, Mike is on there. What's going on? What up? If you haven't watched the video from last Friday, we are talking about interest-only mortgages today. The video that we dropped with Matt on Friday outlined commercial and institutional private mortgages, advantages, disadvantages, why you would use them, why you shouldn't use them. So today we're just going to go in a little bit more detail as to why you would and wouldn't use it and in what situation. We touched on it quite a bit throughout like our other chats, but we wanted to create a whole video on it.
I think the big difference with this last video is we touched on conventional interest-only mortgages a little bit more, which we haven't really done in the past. Institutional interest-only, it's really big in the UK. There's a couple of clients I've talked to who came from the UK and super popular over there. I mean, the big difference is just, buyers are really looking at what's affordable for them and not necessarily what puts the most amount of equity back in their pocket. So, if you guys are really concerned about cash flow and you're not so much concerned about building up that equity, and market appreciation is enough for you guys, trying to find an interest-only product might be worth it. There's not a whole lot of lenders who do it out in Ontario. It's gaining a little bit of popularity. I think there's a couple A lenders who do it, and then maybe one or two B lenders who offer it. But the interest only is really just that. It's just an interest payment, so you're not paying down any of your principal amount. But with the interest only, because you're not putting anything towards that principal, it does lower your monthly mortgage payment, which in turn does increase your monthly cash flow coming in. So, for those investors out there who have their rental portfolio and want to focus on building up that cash flow, interest only could be a potential solution for you guys.
Yeah, so we break down both institutional, conventional, and just residential interest-only mortgages. Why you use them, why you wouldn't use them, how people use them as like a tool. We actually just did a podcast today. It's going to be released. We talk a ton about just private mortgages in general and how they work. But looks like we got a few people on here. Thank you all for joining. I guess we can get right into it. Talking about commercial first, because a lot of our clients right now are buying those multifamily 6 units and up. Most lenders in the commercial B space offer this product. They're going to offer some sort of interest-only loan, and when we say interest-only, like there's a lot of negative connotation just around why somebody would take this. But when you look at it through a investor perspective, being able to get your property on acquisition into an institution instead of a private loan, taking on that interest-only payment is more beneficial than taking on all the overall cost of acquiring a property privately.
Yeah, when you're picking up a under-rented building, the main concern from any lender is just cash flow in that building and its inability to carry itself as an asset. As we've talked about, a conventional lender wants to see a 1.2, 1.25 DSCR on a building that has 3 to 4 vacancies, or maybe it's severely under-rented. With that building just doesn't come in at a 1.2, 1.25. It doesn't have enough cash flow coming in. So one of the things we take a look at is a repositioning loan on acquisition. Typically, it utilizes a couple different pieces to help get that debt servicing within the ratio that B lender is looking at. And on the commercial side, instead of 1.2, they're looking at a 1.1%. So they do that, one, by decreasing the loan to value, so you have a lower loan amount. But secondly, they switch to a 5% interest only mortgage. And when we compare that to a 3.5 to 3.7% mortgage at 25-year amortization, your monthly payment is actually lower most of the time. That helps to increase your cash flow, and that can turn a private mortgage or a private, commercial solution into a B mortgage solution with that increase in cash flow. So it is a strong tool when looking to repurpose and get into a building and being able to save some money on fees or keeping it on the B side with a better interest rate. So
yes. So the way it goes is you start at 25-year AM, and if you're with the B lender, you try 30-year AM or 35-year AM. Now, if your debt servicing still isn't lying, you start looking at the interest-only option. For reference, the difference between a $500,000 loan that's amortized at 25 years and interest only, the 25-year AM is $2,908 a month versus $2,061 a month. We're talking about $847 a month in extra cash flow, which is significant when it comes to qualifying for your multifamily on acquisition. So, something to take into consideration. We obviously recommend going that route over taking like a 7.5 or 8% loan, but definitely needed when taking on a property that is underperforming.
Yeah, everything is situational on the real estate side of it. Like for financing, there is no one product fits all. There's pros and cons to every product, and you have to understand what it is that you guys want and what kind of benefit do you guys need, what pros of a product do you guys need, and what is your preferred outcome. Like we said, if it's cash flowing and you guys want to be able to be in a position while you're repositioning a mortgage to have it cash flow, going at a 65% loan to value interest only mortgage at 5% puts money back in your pocket year after year while you're repurposing the building, getting new tenants in, doing renovations. It puts money back in your pocket. Whereas if you're going with a private mortgage, if it's severely under rented, you guys can get into the building maybe at 75%, but you're not putting any money back in your pocket every month, right? So it depends on how under rented that property is. But having that option to have money coming back in your pocket in the initial year and a half while you, like I said, reposition that mortgage, that can be quite beneficial if it's helping to pay down some of your renovation costs. And something else to consider too is some of these lenders who do this repositioning mortgage, they can allow you guys to borrow up to 65% of the renovation costs as well too. So on a rebate type program. So whatever renovations you guys wanted to do that were approved by the lender and had quotes for, they may give you up to 65% to help cover those. So
yeah, those specific products do require the borrower to have some sort of history in doing that type of loan, but there are some pretty cool products out there on the market. The difference between that, commercial interest only and like an actual private interest only, an actual private interest only loan isn't going to have a minimum debt service coverage ratio. So if you do have a ton of vacancies on possession, that might be a reason why you'd go actually private instead of trying to go institutional private. There is no minimum NOI to support. It's essentially just an equity loan based off of the true value of the property at the time of purchase. If you have non-conventional down payment sources, so if you want to use the collateral in other properties as a down payment source, you could look at using that through a true private loan, just to minimize the overall down payment required on your end. If you had cash available, cash reserves to do renovations instead of actual acquisition, you could figure that out. We could structure that, and for the privates, there aren't a whole lot of down payment history requirements. So if you had a JV partner, and the JV partner didn't want to be in the deal, but they wanted to give you money, you could, but you wanted to create a contract in the back end, and you could do that. Whereas institutional private lenders, they would require some sort of down payment history, and you would have to tell them, how the funds are being used for the down payment. So, all things to keep in mind. There are advantages and disadvantages of both. It really just depends on, I guess, capital up front, what you want to do.
Yeah. Like I said, each product has its own specific use case scenarios. Typically, these interest-only products for repositioning do come with a lower loan to value, 70 to 65%. So you do have to have the cash to be able to get in. They can utilize a vendor take back. It does have to be debt service, so we would use it as a second mortgage, make sure the building is able to carry that. And if it can, then you're good to go. But if you don't have the cash to get to 65% or 70% loan to value, then you're really looking at a private mortgage. In which case, again, depending on how under rented the building is, you may not cash flow in the first year. And I think that's something that we get a lot when we talk about using a private mortgage as a tool. Is the client will say, well, I'm not, I'm losing money in my first year. And yes, like you probably are in some of these circumstances, but like what is your goal with this deal? Are you looking to get into the property, or are you looking to make money in your first month? If you're looking to just get into the property so that you can cash flow it down the road, then it doesn't necessarily matter what your cash flow is in the first year. Yes, you're going to lose money, but in the long scheme, you're going to make that money back over time. If you're that focused on immediate return, you're probably just looking to flip the building anyway. So it's perspective and cost of opportunity. Like I said, if you're really that worried about being $500 in the negative each month, you might just want to wait until you have enough cash to get into a conventional mortgage, because
repositioning a property isn't for you if you're worried about the cash flow in the first month of trying to reposition a property. The entire premise of that strategy specifically is you're buying an underperforming asset,
and flipping it into a cash flowing asset. So there's, it's underperforming when you go into it. There shouldn't necessarily be an expectation to make that cash flow within the first year of repositioning.
Yeah. So some of the types of the truly private money in the commercial market, we got mortgage investment corporations. They are federally regulated. They have basically lending guidelines that they have for their shareholders. They lend out money, decent rates. You're probably looking at like 7 to 7.5 and up, depending on the type of property you're looking to purchase. Yeah. Truly private capital, just mom and pops, very rich people who are put money in the market who understand real estate. And then, private capital groups, you have people who pool their money with other people to be able to put cash in the market. So there are a handful of different types of capital, all having different interest rates, different down payment requirements, different geographical places they can lend money. Some are strict, some are not. Each one has a unique solution that it gives. So it's really just dependent on your specific situation and then finding a solution for that situation.
Now on the residential side, kind of getting away from that commercial large multi, there are a couple lenders out there who will do just standard residential mortgages at interest only. I think the most common one that I've seen right now is about 1.87% interest only. Now, again, they do often decrease the loan to value because you're not paying anything down over time on the principal. The lenders do want to have a bit more conservative equity available. So, you're probably looking 75 to 65% loan to value with emphasis more on the 65%. So, they do require a little bit more of a down payment or an equity position in the mortgage, but it does give you guys the availability to cash flow the property a little bit more. So, I had lunch today with a couple of clients of mine who don't necessarily care so much about creating that equity position in the property. They have a little bit more capital reserves than the average investor, so they aren't as concerned. And their main concern is cash flow. They want to be bringing in that money month over month. So for someone like that who has a little bit more capital expenditure and can put the larger down payment down and get into that product, or already has a free and clear property, refinancing, if you want to pull some equity out at 65% and get into an interest only product, you have now you have cash flow still. You're taking on a smaller loan payment than what you would on a principal and interest payment. You have a little bit of more of an equity position than an 80%. You have 35% equity in there, so you still could refinance in the future. It still does give you that availability. You're in a safe equity position, but having that interest-only mortgage does increase the amount of cash flow you have month over month.
It's interesting because I was watching a video on this gentleman who he's a big investor in the States, and he lives off of just interest-only. That's all he does. So there is a strategy to it. Obviously, capital appreciation isn't his goal. Cash flow is his goal. And then just having the tenant year-over-year keep the loan, I guess, to where it is and just take the cash flow and reinvest cash flow was something that he was looking at. Obviously, principal pay down is something that we strive for, but not something that is specifically focused on for every investor, especially in Europe or the States. It's really big. So it's interesting to see how other people utilize kind of non-normal ways of investing.
Yeah. And like I said, it all comes down to just what your goal is. And I think we keep preaching this kind of time after time again. It's, there is no one product fits all type solution in real estate financing. Everything is very specific. Everything does have its limitations. So you really need to know what it is that you need out of that product. And that allows us to give you guys the best product. If you don't know what you want and you just want a mortgage, like, we have hundreds of mortgage products that we can put you in. But which one is going to be the best for you? We can only really determine that if we understand what your goal is now and what your goal is in the next year, 3 to 5 years as well. So you kind of have to help us out by having that having your game plan already in place and giving us something to work on. We can put you in any product, but if we don't know what your goal is, it may not be the best product for you guys. So having that in advance definitely helps.
So residential conventional loans, on the interest-only side, as Aaron was saying, there aren't a ton of financial institutions right now that are offering it, but there are some. It does come with some strict limitations in regards to the total loan to value. You do have to debt service it and based off TDS. This is a cash flow play, and there is restrictions on total purchase value. So if you are looking to do this, you may get stuck within like a little box that you have to play in. In regards to the actual truly private side, some of the advantages of it, just strictly speaking, have no debt servicing ratio, so you don't have to keep in line. There's no conventional down payment sources. So you can use VTBs, JV funds, collateral. More of like a solutions-based approach, not a long-term approach. Mm-hmm. Whereas the conventional private side, they can give you some longer term. So it's more of a long-term cash flow play at that point.
Yeah, and it's important to note that when we talk about an interest only on the conventional side, you still have to qualify for it. So it is a income verification type mortgage. We do need income docs. This isn't a private. It is a A bank, B bank type product. So we still do need to qualify within certain debt ratios. It's not true private. It is a bank type interest only. And then, as Josh said, there still are private lenders who can do a 1 or 2 year term that could help with cash flow as well. And we just had a question here from Amando. When it comes to HELOCs, are they capped at a certain amount of money or a certain LTV?
65%.
Yeah, 65% is what the new regulation, well, not new, but came into effect a few years ago now. 65% is the maximum that you can do for a HELOC. So depending on what the equity position is on the property.
There are some really cool HELOC products out there. One being the STEP product, obviously, the Scotia product that most people know of, but there's also something called the Fusion product that MCAP has. Essentially what it is when you pay down your mortgage every single month, the principal amount that you pay down in your mortgage gets added on to your home equity line of credit availability. So you always have that growing home equity line of credit as you pay down your mortgage. So it gives you access to the equity in your home while you pay it down, which is pretty cool. Little known fact, standalone home equity line of credit products are not available in the broker channel. So we do have access to home equity line of credit products, but it is something that you do have to take advantage of when refinancing your home.
Yeah. The only product that we really have access to as a standalone is a private HELOC. So it's a 1 year term. Same thing, up to 65% loan to value. The interest rate is going to be a little bit higher. But that would be a really good product if you were looking to do a larger product and you just needed access to capital, equity capital for a short period of time. Getting into that 1 year term HELOC gives you access to it. You can draw upon it. You just pay as you use it instead of doing, a private second or a private refinance, a short refinance where you're paying on that right away. And there's some like larger setup fees. If you don't know if you're going to need the whole $100,000, a 1 year HELOC product on the private side could be the option to be able to access as much capital as you need, and then just pay it all off afterwards without putting too much of a monthly payment on there like a refinance would.
Got a question from Multifamily Amanda. On the commercial side of the interest-only mortgage, is it also based on income for these?
Yes, but in a sense, based off of the income produced from the property. So they're going to debt service it based off of the debt service coverage ratio. So they're going to take a look at how much income is coming in versus the expenses. On these repositioning mortgages, they want to see a 1.1 to a 1.25. So it does allow for a little bit lower debt servicing. I mean, on the commercial side, they don't really take a look at your personal income and how there is no personal debt servicing that they take a look at. They do ask for your personal net worth, and they do want to see that they're going to ask you what your income is and just take a look at that. And basically just comes down to like, how strong is your personal covenants? If you're making $20,000 a year and maybe it's just part-time income, but you've consistent history, they may not be too fond of that. Essentially, they want to know if COVID hits and a bunch of your tenants lose their jobs, or if a bunch of them start applying for, some pauses in their rent payments, do you have the income to be able to support, some of these losses or decreases in rent? If the building needs renovations and, do you have the cash flow outside of your cash flow coming from the property to help be able to, pay for their renovations? So
yeah, and I've seen this a lot. So I've had a few clients reach out for larger buildings recently. You're looking at about $2.5 to like $4 million buildings. And one of the first questions that comes out of a lot of these banks' mouths are, what is their experience? So, these people have maybe 2 rental properties, single family homes, maybe another one. They have a bunch of money saved up. They want to get into larger play. But, I'm trying to get to the point where like the entire thing is based off of your overall application. So, what is your experience? What is your down payment? What does your capital reserves look like? What does your employment look like? These people cleared $1 million a year. So, it makes sense for them to be able to do these things. But, getting into the larger buildings, you almost need to dip your toes in like a 6-plex or a few 6-plexes to be able to get into these 12 or 15 unit buildings on the conventional side. They do want to see some sort of history of managing properties like this. And something to note as well is if you're looking to take on CMHC financing, one of the requirements is that you have 5 years of history, taking or managing a property of that type. Now, it's kind of like the whole resume thing. You need 5 years experience for an entry level position. We get it. It's not something that's set in stone, but it is something that that is there and something that they do look at. So, having past experience and being able to show your past experience, whether that's just managing, a portfolio of a handful of rentals or whatever that is. Obviously, there should be a progression of graduation there as single family home, duplexes, triplexes, 6-plexes, 12-plexes, and so on and so forth. And we get you on a scale. But going from owning my home to buying a 20-unit apartment building is a big jump. So for a bank, they just want to make sure that all the pieces of the puzzle fit. It's not just one of those things where you just want to jump in because, it's just a good idea.
Yeah. And I mean, I know we talk about commercial stuff. You don't need, to show the same personal income, and you don't have the personal debt service in that. And I think it's important to note that it doesn't just mean you can show up with a 24-unit building and have no income coming in and say, look, it debt services. And, that's great. But they are still going to take a look at your personal covenants as a guarantor, because you're going to have to guarantee this mortgage, or you're either putting it on your personal name, in which case you're still personally guaranteeing it. But they just want to make sure that you're a strong borrower. If you don't have any income coming in and this property is just debt servicing the bare minimum, they're going to have some problems because, like I said, if the tenant loses their job, or if there's a long turnover and the tenants aren't paying, you have a couple of vacancies for a while, who covers that loss in income, right? Who's paying for the mortgage if you don't have any income coming in? And the same goes, if you guys do have a business for self, or maybe you don't show as much income coming in, again, it doesn't necessarily kill the deal, and they aren't necessarily just going to go ahead with it. All these deals are on a deal by deal basis, and it is based off the strength of the whole application. The first thing they're going to take a look at is, does the building debt service? Yes, great. Now, what does the borrower look like? is it a strong borrower? Is it a medium borrower? Is it a new or a bare minimum type borrower, right? And those secondary questions can alter the application. They may not feel as comfortable lending at 75% loan to value if you don't have any other income coming in. Maybe they drop it down to 65%. So I guess my point is that we talk about very specific points that are advantageous to you guys, and we highlight the key points, but it is deal by deal type basis, and it's not always guaranteed to be able to get done. So
it's not black and white at all.
Yeah.
It's there's so many different aspects that go into commercial deals that it's not like definitively you check all these boxes, you're good to go kind of thing. So just keep that in mind when you're applying for these larger multifamilies, that they do want to see some sort of experience. And last but not least, for the interest for the private money, we want to talk about HELOCs. I know Aaron touched on it a little bit ago, but home equity lines of credit are great tools to have when you're investing in real estate, specifically because the amount you have to actually pay or you're required to pay per month is only the interest amount. So being able to access that and set that up before you start your real estate investing journey is super important. So if you own a home and you don't have a home equity line of credit and you're looking to scale your portfolio, do it before you start scaling, because you still have to qualify it with your personal GDS, TDS ratios. If you get a bunch of rentals, it's going to be very difficult for you to do that. So highly recommend having the access to decently cheap money before you start, trying to scale your portfolios.
One more question coming in from Dwayne. What is the formula for figuring out the minimum net worth of the borrower? So
total assets.
Yeah, you're basically just looking at your total assets minus your total liabilities, and you'll be left over with a number. Now, the minimum net worth in terms of being able to apply, there isn't really a minimum net worth. The stronger the net worth, the better.
For CMHC, there is.
Yeah, for CMHC, you have to have minimum $100,000 or 25% of the loan amount, depending on which is the minimum. But for most standard applications, they don't actually have a minimum. They just higher the better, really.
Yeah. It just adds strength to the application.
Yeah, I mean, you could have if you have a $300,000 salary position and it's your first time buying an asset, but you have a strong history of income coming in, they may not necessarily care about what your minimum net worth is, as long as you can show that you have that cash flow coming in and maybe you don't have a whole lot of liabilities. So, they take a look at it differently on each application, right? But yeah, CMHC, there is a minimum of 100,000 or 25% of the loan amount, and then standard conventional uninsured, it's not really a minimum value.
Yeah. Multifamily Amanda just chipping away to 12 plexes. I love it. Right on. Do you guys have any questions for us today? With this one's kind of not short, but we just wanted to go over conventional, residential versus commercial private money and how it's going to affect you guys. A lot of our clients that we deal with do use it as a tool. It is effective to be able to for short-term applications. Long-term, there is no long-term private. There is long-term conventional interest-only loans that are beneficial for cash flow purposes, but for very expensive private loans, it's not super advantageous to hold it for a long time.
Yeah, one thing I'm kind of curious about for all the investors is just how you guys have found tenant turnover with the eviction restraints in place. Are you guys having troubles getting tenants turned over? Have you guys turned to cash for keys a lot? What are you guys finding to be the most successful?
Keep talking.
What are you guys finding to be the most successful strategies to get the tenants turned over? Because that's something that we've been finding is there's still a lot of under rented buildings out there. And if it is under rented, a couple of the options are either we go with a 5% interest only, type B product, see if we can get it to debt service at 1.1. If it does, great. But, again, that 65% loan to value is definitely a large increase in down payment, especially when the building needs some renovations itself. Flipping over to a private side can be a cheaper solution in some circumstances. If you're comparing 65% loan to value versus, a 75% loan to value, sometimes the fees and stuff included in that down payment, it's actually cheaper to go on the private side. But again, when you take a look at exiting, obviously you want to be able to refinance out at the end of a year or a year and a half. So just trying to figure out how the investors have been finding it, what tenant turnovers are like. If you guys have had any issues or problems, would be great to know.
Yeah, we actually, one of the things that that is super important to realize as well is that CMHC actually has a list of verified lenders that they can refinance out of. So if you are purchasing property in through a private lender, just make sure that that lender is on the list or does work with CMHC for your exit strategy, because you could be in a situation where you're in a private, then you got to refinance into a B lender, then you got to refinance again into CMHC. So, always something to keep in mind when you're looking at structuring your takeout financing on the back end.
Yeah, multifamily. Yeah, we had one. We were able to get an eviction during the ban. Fill quickly. Awesome.
Yeah, we're finding that a lot of the clients who are repositioning properties, once they actually obviously do the work, it's not difficult. There's a huge demand for people looking to rent the properties, and they're renting for astronomical amounts, especially in Kitchener-Waterloo, Cambridge, Guelph, Toronto areas. Like the rent is decently high at the moment. A lot of clients, the whole cash for keys thing isn't as effective as it used to be right now, just because a lot of people understand that there's a moratorium on getting people out. So it's a little bit difficult for a lot of people to be able to execute on that strategy at the moment.
Yeah. What else we got here? Any other questions coming in? No.
Right on, guys.
Yeah, but in summary, interest only, if you're looking just for a cash flow type product, and your primary concern is how much money are you bringing in month over month, definitely let's chat about interest only mortgages and see if there's a product that's right for you. And we can take a look at how much extra cash flow you'd really be bringing in, and what that's going to save you in the long run. And the market's going to appreciate in most circumstances, naturally. I mean, right now we have huge natural growth. So, it's not like you lose all ability to increase your equity. It's not going to be increasing as quickly as if you had a principal and an interest plus the market appreciation. So, realistically, the amount of equity you pay down on a principal and interest loan anyways isn't that huge. Obviously it's better than not paying it down, but in the grand scheme of things, you may not be losing out that much if you just went on interest only and market appreciation. But again, it depends. Situational. What exactly do you need as an investor? And that's what Josh and I are here for, and providing a solution specific to what your needs are.
Yeah, explore all the options. At the end of the day, the options are just making an informed decision with all the options available to you is, all we can do to help you move forward with your investing journey. So, if you guys have any questions about, does it qualify? Does the building qualify? Do I qualify? What does it work? We are here to help you make an informed decision. And for all the people who are on today, especially Multifamily Amanda, for saying thank you. We do appreciate all of you guys every Sunday coming and joining us. If you guys have any questions, feel free to leave it in the comments below. We'd be happy to answer them next week, or just shoot us a DM and we can talk about it, throughout the week.
Yeah. Thanks for tuning in, guys.
All right, guys. You guys have a great weekend. Enjoy the rest of your Sunday, and we will see you all tomorrow, hopefully.